Good morning, good evening, everyone, depending on the part of the globe you are at. This is the FMI broadcast number 5 of FNA. We'll start in a couple of seconds. Okay, I think we can start. Once again, welcome to the 5th session of FNA's Financial Market Infrastructure broadcast. We're really happy you're joining us today here in this broadcast. As usual, I'm Carlos Leon. I am your host in this series of FMI broadcasts. While the audience enters into Zoom, we'll have some housekeeping. The FMI broadcast follows a 60-minute format in which our guests will provide expert insight into the latest developments and innovations influencing the FMI industry today. You can use the Q&A widget below to ask questions, and the speakers will aim to answer as many as they can during the 10-minute question and answers part. Please do not forget Chatham rules, house rules apply to this broadcast. So before entering into matter, let me talk about FNA. FNA is a leader in advanced network analytics and simulation. FNA's software is used to uncover hidden connections and anomalies in large, complex datasets, to predict the impact of stress events, and to optionally configure financial systems and infrastructure. As you can see in the list of logos that we have on the right of this slide, FNA is trusted by the world's largest central banks, government authorities, commercial banks, and financial infrastructures. And also let me briefly cover some of the things that have to do with what FNA does for FMIs, legacy FMIs and challenger FMIs regarding the life cycle of financial market infrastructures. FNI's lifecycle solutions enable FMIs and FMIs overseers to effectively respond to evolving regulatory environment and the payments landscape. So we have in this life cycle, like the two parts, like the two sides of the life cycle, which is building the financial market infrastructures, solutions or products, and also the operation and the oversight of those solutions and products. So the top or the most interesting things about what we do with FMIs is to reduce the design and validation costs while increasing the effectiveness of those solutions. Second, increasing the effectiveness of attaining regulatory approval and member engagement. Third, to improve regulatory compliance and oversight and enable FMIs to manage the risk in a proper manner. And fourth, optimizing system design and parameters to reduce risk and increase efficiency. That's what we do at FNA for the FMI lifecycle. So let me introduce Jan Schoombee, our broadcast guest speaker today. Jan is the Chief Financial Officer at Fnality International. Jan has more than 20 years of experience across multinational listed financial services groups and entrepreneurial growth ventures. He has worked as CFO, founder in commercial roles covering business development, product innovation, and corporate development. His sector exposure includes banking, insurance, payments, and fintech. Jan has a keen interest in technology and how it's changing the business and entrepreneurial landscapes. Jan is a chartered accountant with master's degree in history and qualifications in finance and marketing. So Jan, welcome to our 5th broadcast. And if you have anything else to add to my brief presentation, this is the moment. Otherwise, we can start with the broadcast.
No, only to thank you for having me as your guest today. Really appreciate that. Fnality works closely with FNA, and it's great to be with you and everybody watching the broadcast today. It really is about the ecosystem for Fnality. So we see everybody in the payments ecosystem as our collaborators and our partners. So really great to be here today.
Thank you, Jan. I'm going to make a very brief summary of what we expect to cover today. And it's, as usual, we start with this summary in which we highlight that financial market infrastructures are trying to solve the long-lived demand for efficient cross-border payments. In the case that we have today, it's very clear that new technologies such as DLT, distributed ledger technology, along with access to flexible and affordable computing services, have encouraged the development of solutions that aim at fulfilling the market's demand for better retail and wholesale cross-border payments. And obviously, a great deal of this demand for better retail and wholesale payments have to do with managing liquidity in a more efficient manner. So in the FMI broadcast today, we're going to discuss with Fnality, with Ian, which is a very well-known challenger FMI, how to contribute, or how Fnality contributes to a quicker, safer, and more efficient exchange of value in the global wholesale financial markets. So the idea that we have today is to discuss how a Fnality, a challenger FMI, could contribute to the safe and efficient functioning of the whole wholesale cross-border payment ecosystem, having a somewhat focused on wholesale liquidity and how it's managed. So after this brief introduction, let's start, Ian. Thank you very much for being here. First question is, can you tell the audience a bit more about the role of Fnality in the wholesale cross-border industry, please?
Yes, of course. So a little bit about Fnality, and as a background for those who might not be very close to the company, and to start off with, and then I'll go into payments specifically and how we fit into the wholesale cross-border space. So we were founded in May 2019, and we have about 100 people working in the company right now. And we focus on the wholesale market specifically. We use DLT technology, distributed ledger technology, to enable atomic, in other words, near real-time settlement cross borders with a settlement asset held at central banks. So there's a couple of things in that sentence that are important to describe what we do. The money held at central bank is key to our value proposition and what differentiates us. It makes it risk-weighted asset zero. It makes it a high-quality liquid asset, creating benefits for our participants. And the second bit that I want to highlight is the cross-border nature of the business. So we will be setting up regulated Fnality payment systems in a number of jurisdictions: pound, dollar, euro, Japanese yen, Canadian dollar, etc. And each of these will be regulated and governed by their respective central bank and the corresponding regulations. We are backed by global financial institutions. We have 14 banks, 2 FMIs, and an asset manager as our shareholders. And we also see them as active participants, both in use case development and adoption, as well as our clients. In reality, they are our anchor clients that will drive the adoption of the Fnality payment system into the marketplace. As I've mentioned, we've had deep engagement with regulators from the very start, even pre-inception, across the 5 core currencies that I've spoken about earlier, so the pound, the dollar, euro, yen, and Canadian dollar. And lastly, I just want to mention that although we use DLT, we see ourselves as operating on that intersection between TradFi and DeFi. So right now, if we think of the crypto space, for example, that's less than 1% of cash. 99% of money is still in traditional financial institutions. Yet the DLT space brings interesting technology and business models to the table, which we believe, when combined, is an opportunity for traditional finance institutions to innovate and change the way in which business is done for the better, reducing risk, reducing costs, but also enabling new value propositions for their client base. So the future winners, we believe, will be companies that can embrace the intersection between those worlds of traditional finance and decentralized finance.
Thank you, Jan. And something that I would like to highlight from your answer is something that was already mentioned in previous versions of the FMI broadcast, in the sense that one key player in the cross-border payment solutions are central banks. That if the central banks are not into the equation, it's most likely that the solutions are not going to be so far-reaching, and that they will not allow a better functioning of the system. So you mentioned that that Fnality works closely with regulators and with central banks. So I think that's something that in the latest versions of our FMI broadcast we have heard a lot, and I think that that's a very interesting point in what the Fnality is doing right now. So I just wanted to make that highlight, because I think it's rather important, and it links everything to the previous versions of our broadcast. So thank you for your answer. It was very interesting. The second one is obviously related to your first answer, and it's from the perspective of a challenger FMI. What are the key challenges that in the cross-border payments ecosystem you're trying to tackle?
Yeah, so a new business would only exist if they've identified a problem and believe they have a solution to that problem. So we believe the current way in which cross-border payments is done has a couple of advantages that technology can fix. So it's disjointed and intermediated in terms of processes and the number of parties involved in making a payment, which leads to fragmentation and fragmented and trapped pools of liquidity, which is also costly from an operational point of view, but also from a risk management point of view, which places pressure on margins within the institutions involved in them. I'll give you an example. McKinsey does an annual report on global payments. And in one of their sort of older reports, the 2015 one, they cited research from a company called Traxpay. And Traxpay found that in B2B payments, around 60%, required some sort of manual intervention, and that each intervention took 15 to 20 minutes to resolve. So if you amplify that across the entire ecosystem, that's a lot of cost and a lot of time being spent, and obviously also it introduces operational risk, which soaks in capital. So the other side to that also is the risk management angle. If you have a lot of intermediaries in a chain processing a transaction, it's hard to have a consistent approach to risk management, AML, KYC, etc., applied throughout that entire chain. We've seen banks responding to that. One famous example is JP Morgan, and they reportedly cut ties with 500 network banks due to the inconsistency of the application of risk management across that chain. So all of these are examples of what we see as things that can be fixed. I want to reference one more report, which I think most people on this call will be familiar with, and that's a report done by the FSB on the sort of roadmap for enhancing cross-border payments. People, I'm sure, will have seen that it was presented to the G20 as a roadmap for enhancing cross-border payments, focusing on public and private sector commitments, current infrastructures, new infrastructures, data and market practices, and also to the point you highlighted earlier, Carlos, the role of regulators and as critical within the ecosystem. And there are a couple of points within that report. Those kind of 5 themes are built out with building blocks. And there's a couple of points or building blocks where Fnality has clear linkages. So access and opening hours is one. PVP adoption, very clearly, that's building block number 9. As well as building block 13, which is about interlinking and interoperability to reduce fragmentation. So it's interesting for us and to see that some of the thought leadership in this space also affirms the direction that we are heading in.
That's really interesting, Jan. Thank you. I would like to I always try to like wrap up the answers to have like some highlights about it. And I liked a lot some of the things or the issues that Fnality with technology is trying to solve. Fragmentation, meaning like the silos that are into the cross-border payment ecosystem, the operational risk, the inefficiencies, and the inconsistencies in the operation. And that statistic that you mentioned about 60% of the payments being like or having some kind of manual intervention is all obviously striking, and it tells us a lot about how technology can help making the cross-border payments more efficient and obviously safer. And that's something very interesting. And it is very interesting to once again to have like a contrast with what had been said in the previous broadcast, because for instance, last time, if my memory is working well despite the flu I have right now, it is that last time they said that technology would be able to solve something like 5 or 10% of the problems of the ecosystem. The other things have to do with regulation, with good practices, with the central bank intervening, with the regulators intervening into and cooperating into the system. So this 10% anyway is very, very big, and all those inefficiencies obviously are worth tackling together with the good regulation and good intervention by the central bank. So it's very interesting, your answer. Thank you, Ian. So the third question has to do with what is special about how Fnality manages liquidity. So it's what is the advantage that a challenger FMI like Fnality could offer in terms of the efficiency and cost when you compare it with traditional correspondent banking, for instance?
So what Fnality enables is real-time settlement of transactions on a cross-border basis. So the Fnality payment systems that will be set up in each of the jurisdictions will interoperate and will be able to settle using blockchain technology cross-border at almost instantaneous. So it turns T plus 2, T plus 3 into T plus instant, couple of seconds. And that speed allows the movement of money into a single pot of liquidity and alleviates the trap liquidity along the chain and the liquidity held at counterparties. The money within the Fnality payment system is never held on Fnality's balance sheet. It's always within an account held at a central bank. So it has the characteristics of central bank money. It's always one-to-one fiat. It's deposited within a central bank account, which provides the risk-weighted asset and high-quality liquid asset nature of it. So in terms of the cost of capital and the cost of holding liquidity against and capital against open positions, that is eliminated by the ability to move money around different currency pots and control the float of money with an instantaneous settlement engine that operates and enables that. So that's the first sort of direct impact in terms of the way that a Fnality payment system works, which reduces cost, reduces time, reduces friction, and therefore reduces the amount of intraday and overnight liquidity that needs to be kept. There are other benefits as well, which might be secondary and not immediately obvious, but it's benefits such as helping reduce operational risk and costs by having a single rule book. So there's clarity that every participant has signed up for the same rule book and therefore has the same has cleared the same bar in terms of rule book adherence. And then the other component, which is more directly linked again to the ability to handle and optimize liquidity, is that the money is on a DLT system, so it's programmable. There's one can add a smart contract or conditionality. If this happens, then that happens. Logic to the money held on the payment system. And that allows various use case applications. For example, initial margin and variation margin, where if there's a margin call, that could be a logical statement. It can be topped up, which again reduces the money held at counterparties for that kind of settlement, and it also allows that money held in a very high quality asset form because it's kept at a central bank. Another example might be trade finance, which clearly links it the way that letters of credit works. Is clearly something that has a logic attached to it that's programmable. And it reduces the trapped liquidity, the counterparty risk, but also the wastage that comes with failed transactions, failed margin calls, and trades that fail. To put some numbers behind that, a report from Oliver Wyman and JP Morgan mentioned that the global corporations that rely on wholesale markets move apparently nearly $23.5 trillion, across a quarter of global GDP, across the world annually. And that costs $120 billion for them to do that. So if the velocity of money and the velocity of movement of money is expedited, it has clearly tremendous benefit also, not just for regulators and banks, but also for their customers in terms of their ability to move funds and get access to funds quicker and enable trade and economic growth through greater movement, greater velocity of payments.
That's a very comprehensive and interesting answer, Jan. Thank you very much. I'll wrap up in just a couple of words. It's alleviating trapped liquidity, which obviously has very interesting outcomes or consequences in terms of efficiency of the economy as a whole, growth, development, so on and so forth. Also, it's always central bank money, so it's always available for the clients to use it in some other things. I mean, and I presume that you're referring to reserves at the central bank. So that makes the clients that enable the clients to use the money in interbank payments as usual. Third, reducing risks, counterparty and operational among those risks. And obviously, and this is a very interesting part, is in introducing programmable money into the wholesale cross-border payment ecosystem. Your examples, margin calls, trade finance, which are obviously very big parts of how financial markets work or have to work on a daily basis. So that's very interesting. Next question has to do with F&A. So it is when you designed a building, and when you designed and built the business and obviously the operational model, this is a very important part of what an FMI, a challenger FMI as F&A, as Fnality does. So can you tell us a little bit about how Fnality addressed the design and build phases of your cross-border wholesale payment solution?
Yeah, that's a really interesting question. And the way I always think about a business is that it's a bit like a tripod. It stands on three legs, and those legs are the technology that enables the payment, the regulatory side of the business. We are seeking regulations, have actively seek to be regulated from the start, and will be operating regulated payment systems. And then the operational side of the business, so the ability to run an operational payment system. So technology, regulatory, and operations are sort of the three legs. And if I think of how we've built and stood up the business, we emphasize the different components of that from inception to where we are now. So roughly there are three phases up until today. The first one was the pre-incorporation phase, where some of our founding shareholders ran Fnality as a project with the key question of whether it's viable and whether conceptually central banks would buy into what Fnality aims to achieve. Once that was established as a yes, we raised our Series A funding, incorporated a business, and start growing it. So during that first pre-incorporation phase, the emphasis was very much on the regulatory leg. We then, post Series A, started focusing on the regulatory leg and the technology leg, and we started building the product out. We started engaging with our technology partners. We follow a system integrator approach. So we started engaging and contracting with best-in-class development houses and blockchain specialists to build a tech stack out. And then April 2021, we entered a new phase when the Omnibus account was announced by the Bank of England, and we immediately applied for the Omnibus account. We then started our third phase, which is an accelerated build phase, to execute and to get ready to launch with sterling as our first currency. And the third leg, the operational processes, procedures, and governance started becoming important, and we started emphasizing that leg a lot as we get ready to launch. So if I look back on that journey, our relationship with FNA, our host today, really goes back right to the start, and it has also changed as we went from regulatory to regulatory plus tech to regulatory plus tech plus operations. When we started out, I think one of our very first engagements with FNA was to model out the five major RTGS systems and their Fnality payment system counterparts, and to determine, and this was then modeled out and showed by the modeling that there was no systemic liquidity risk to the ecosystem for wholesale payments through the introduction of the Fnality payment system. We then overlaid a PVP model on top of that to answer the same question around systemic liquidity risk. And then as we move closer to launch and go live, we started focusing on the operationalization internally. And again, that changed some of the work that we did with FNA. So we went from the macro level down to the participant level, and we started doing a lot of work with FNA on the liquidity position for a single participant. So a before and after view, if you look at RTGS and cross-border payments and moving that onto Fnality, what do we see as a before and after picture? We know from studies done by Oliver Wyman and others that something like a 25% reduction in intraday liquidity should be possible. We then overlay that with real-world data from some of our shareholders, and that indicated that much larger savings than that is possible at full adoption of the Fnality payment system. So just to take a step back from that, and I'm going to try and do what you do, Carlos, and give it a bit of a summary here. And I think the reason why we walk such a long path with FNA is the clear synergies between where we play and your expertise. So FNA has deep payment system expertise and deep regulatory expertise, and both of those are and have been very valuable to Fnality.
I think this is the only answer I'm not going to summarize. You did it great. I have nothing to add about what we do at FNA with you at Fnality. So thank you, Jan, for this such a comprehensive answer. So next question. In previous sessions of the FMI broadcast, it was brought to our attention that directly interconnecting RTGS systems from central banks could solve many of those long-lived problems of wholesale cross-border payments. What do you think? Is that easy?
I think it's a great idea conceptually, and but I also think that whether that's immediately possible and whether there's a role for private sector is something that one should discuss. There's a July 2022, so a recent report on the BIS website. I think it's done by the Committee on Payments and Market Infrastructure on exactly this topic. interlinking payment systems, and the role of APIs. And they, in that report, mentioned that 10% of surveyed payment systems have some sort of interlinking agreement. So, and they again mentioned why that would be and what problems that could solve. And it's the same problems we've already discussed today: low speed, high cost, limited access, and insufficient transparency. Of course, if 10% have some sort of interlinking solution, it means 90% do not. So why might it be that 9 out of 10 do not have some sort of interlinking solution right now? And there are many reasons. Even in that report, there are many reasons mentioned: political support, high startup costs, different legal and regulatory frameworks, access rules, service levels agreement, different technical design features, difficulty aligning on protocols, etc. So regulators face unique and challenging in environments, especially now. There's a war in Europe, there's an energy crisis, there's inflation. So we believe there is a role for the private sector to play. And whilst this idea of interlinking could definitely solve some of the problems, the private sector can add value to solving this as well. And in essence, what Fnality is trying to achieve is establishing a network of interoperable real-time gross settlement payment systems that settle in central bank money, and which we believe will achieve those same benefits.
Thank you, Ian. That's a very interesting answer. Going to other type of, let's call it DLT or distributed type of solutions like cryptos, which is, I mean, it's like a mandatory topic when we talk about cross-border payment solutions, or this type of trying to send money from jurisdiction A to jurisdiction B. Do you think that those kind of like, let's call them like privately owned crypto solutions like Bitcoin, or those which are privately owned, like major stablecoins, could become large and liquid enough to have the ability to manage large payments typical to international trade and direct investments, and obviously to give like more value to the solutions to the problems that the cross-border wholesale payments experience today?
I think my first thought on this is that crypto is not DeFi and crypto is not DLT. They are sometimes used as synonyms and interchangeably, but I believe banks and regulators should have a crypto strategy, and banks and regulators should have a DLT payments and DLT infrastructure strategy, and they are very different. So the first issue with crypto specifically is price stability. Certainly in Bitcoin, but even in stablecoins, we've seen through the crypto winter that not all stablecoins are equally stable, and it depends on whether the stability is gained through algorithms or whether it's backed by an asset. And if it's backed by an asset, is it fully backed, or is there some sort of gearing or leverage involved? And if it's what is the nature of the asset? Is it a back or of different assets underlying it, or is it high quality liquid assets? Is it money held at a central bank? Which again is where Fnality will play. We will be one-to-one with money held at a central bank. So I think one would need to unpack and look at all of that. Right now, it's less than 1%, so it's growing fast and it's doing really interesting stuff. But most of the money is still not in that space. But on the other hand, there are still interesting solutions and interesting technologies coming out of that space. So echoing a little bit of what I mentioned at the introduction, we believe the way to to really win in this space is to operate on that intersection between those two worlds. And certainly there will be a role to play if you think of JP Morgan coin and other stable coins coming into the space. And what the question is to what extent and what problem is solved by it. So if counterparty risk is a concern, then depending on who the issuer of that coin is, you might be comfortable or not. And depending on, as a bank, whether that's a competitor to your business or not, you might be comfortable or not taking that exposure. In the end, I think from our perspective, having the advantage of real-time settlement that DLT technology allows, but also the advantage of a central bank asset, which gives you the risk-weighted assets advantage, plus the advantage of it being multi-currency. That for us is the sweet spot, and that's why we've positioned the strategy in that direction for Fnality.
That's a nice answer, Jan. And my 2 cents about this, and it's somehow related to what you just said, is that Bitcoin and some other let's call solutions or some products or however we want to call them, they have made something to the system, which is push the system forward to try to fix some of the things that we all knew that there were problems of the cross-border payment ecosystem, the lack of efficiency, the costs, the frictions that you mentioned. And I think that Bitcoin and some other cryptos have pushed central banks and the private sector to find solutions to that. I mean, practical solutions to that. But I also agree with you that it's rather limited how by themselves those solutions could help effectively to overcome those problems. And I think that what it's coming our way is that the private sector and the central banks are importing this new technology, accepting the challenge, accepting the push of these cryptos and stable coins, and doing something better for the system. That's my 2 cents about this, but it's rather related to what you just suggested, Jan. Thank you. So next question is, could interconnectedness between challenger FMIs and legacy FMIs threaten the stability of the global payment system? Is this something that we should worry about, or the regulators should worry about?
I mean, I think it's true that regulators will and are already facing a large challenge with the scope and pace of change and innovation within the ecosystem, and especially on the consumer side, perhaps less so than the wholesale side. So in the retail side, that's certainly something to keep an eye on. On the other hand, regulators tend also to want competition to happen and not have a situation where incumbents are somehow isolated or protected. Plus, there's also the need for regulation to happen under their watch, and to have visibility and line of sight of innovation, as opposed to innovation happening somewhere on the side and then potentially having a much more disruptive impact. So just kind of linking that as kind of general ideas to the question, I believe interconnectedness per se does not threaten the global payment system, because if the same risk adherence is applied to both sides, then opening the gate should not increase the risk. So if there's PFMI compliance, or and it meets the regulatory burden, then the principle, as expressed by the FSB, of same business, same risk, same rules should apply, and supervisory and oversight approaches should then be agnostic to the technology choice. If the risk, procedural and governance frameworks are still there. Again, something that Fnality has sought from the start is to be regulatory compliant since the start of the venture. I should also mention that certainly in the wholesale markets, participants would not use payment systems that they're not comfortable with. So volumes would not flow if the risk and governance frameworks are not to the level that's bank grade and that's acceptable to the institutions that process large transactions. The other thought I have on this is that a well-integrated system that's global can also reduce risk. So interconnectedness can also reduce risk because there is also risk in fragmentation.
Yeah, thank you, Jan. I think that one thing that I would add, or not to add, but to emphasize, is that there should be like a common regulatory like ground for everyone. I mean, like a level playing field, which is something that it's a very common expression in banking or financial systems, but it's difficult to achieve. So I think that those kind of principles, like same activities, same regulations, same oversight, same supervision, is one thing that should be there for us to be, as you said, interconnected is at the end, is the channel, but it's not the cause of financial instability. Perhaps the cause of financial instability is poorly regulated financial market infrastructures, for instance. So that should be like the focus of regulators and of financial authorities, to have everyone like playing on this under the same principles. Perhaps the PFMIs, the principle for financial market infrastructure. That's a good idea of where to start. Our last question before we go to the Q&A, we're right on time for that. It's looking towards the future. How do you see the wholesale cross-border payment ecosystem evolving in the years to come?
I think the clue for us might be in the consumer space. So we are already today seeing massive innovation with companies like TransferWise and Revolut and others offering really consumer-friendly and easy-to-use solutions to move money around cross-border in a transparent, real-time and cost-efficient way. Corporations, banks, everyone on this call, we all individuals accessing these solutions in our personal capacity. And I know corporate banks and corporate bankers are facing the challenge from their corporate clients asking when and the solutions that they are used to using in their personal capacity will arrive for the corporations they run. So eventually in time, we will see the same benefits and banks and financial institutions that embrace that and that lean into that and offer it to their clients will have a competitive advantage because they'll have a stronger value proposition. And we believe DLT, when correctly applied, enables that and makes that a possibility.
Thank you, Jan. Something that was mentioned also in one of our previous FMI broadcasts is that some people expect not to have very tangible like benefits in the years to come, at least in 5 years or so. What do you think about this? I mean, in that FMI broadcast, we were talking about retail cross-border, which is a different topic. But do you think that in 5 years' time, 5 years' time, there would be like tangible benefits for the market? I mean, in this case, in the wholesale market, is that like a right time frame to try to look at?
I think in 5 years' time, there will be tangible, real benefits, although I think that adoption would not be a on-off switch. I think it will be a journey because with in the regulated space, new solutions have to earn trust. So we, as startups, we need to be cleaner, we need to be better, we need to be faster, we need to earn the trust that established players have through their reputation of being in the space for decades, sometimes even centuries. So that trust will take time to build, and it will take time to create an ecosystem that's connected and interoperable enough to create the scale and the benefits that we've been discussing in this podcast. So I think in 5 years' time, enough of that will be in place to show some tangible benefits. And as that ecosystem scales, it is then possible to add other solutions onto it, such as trade finance and some of the other use cases, which will then accelerate the pace of change from a 5 to 10 year horizon.
That's very interesting. Jan, you mentioned a word that we love to hear at the FMI broadcast, which is interoperability. And there is a question from the public and from the attendants, and we're switching to the Q&A section now about that interoperability, which is Fnality interoperable with other challenger FMIs like RTGS Global and others? If not now, is it a part of the roadmap?
Yes, so Fnality is built to be interoperable. One of our design features is interoperability. But our immediate focus is going live with our core currencies. So going live with sterling, dollar, euro, and then Japanese yen and Canadian dollar, creating those payment systems and allowing interoperability across border. So our initial focus is working with the regulators and the direct participants in the relevant RTGSs in those countries. Over time, definitely, yes, we see interoperability with other emerging players as synergistic to what we are aiming to achieve and not competitive to that. So, and that includes other fintechs offering payment solutions, but also fintechs offering complementary solutions that can link into the ecosystem and provide additional value to participants.
And I think that that's a very, very interesting answer, because I think we all agree that interoperability is what makes the system works better. Otherwise, working on silos in which each financial market infrastructure just works like an island, like in a non-connected manner with all the other solutions or products, obviously makes the system less efficient. And I think that the interoperability within local retail payment systems is a very clear problem that we have been tackling in the last years. And I think that in the wholesale payment ecosystem, that's something that obviously has to be addressed as well. So thank you for this question. Let's go to the second one from the audience. Is there further analysis planned on how DLT can aid with liquidity management?
Yes, we're actually working with FNA on a deeper study right now. So I've mentioned the two pieces of work we're doing with FNA. The next level of detail is to take it down to a real cost of ownership versus benefit of ownership level. So to look at what it would cost to run payments on a DLT network such as Fnality, and then analyze what the impact is for the release of trapped liquidity and the release of risk-weighted assets and capital held against those assets, and what that means from a balance sheet management point of view. So in essence, what we are working on as a piece of analysis right now is to do a bottom-up view, so that if you think of a PVP transaction or even a DVP transaction where you're using DLT as the payment or cash leg for a tokenized asset, how does that trade P&L look like? So if your trading desk choose that route of settlement as opposed to a traditional route of settlement, what would the P&L impact be for your desk? That's something that we are quite excited about. It's a piece of analysis that, from a quantitative point of view, has some interesting challenges, but we have some great minds at FNA helping us in that regard.
Thank you very much for that. Next one, Jan. You design and build cross-border solutions, but wouldn't you agree that with all this innovation, you subsequently create new problems?
I won't agree with that. I think there's certainly if we any entrepreneurial business, any new business responds to a challenge that's there, a problem to be solved, and yes, adopting a new product. one could argue that that in itself has challenges. Many of those challenges are things that we as a startup business need to overcome. We need to manage the rollout, manage the infrastructure and the capacity and resources in order to bring the products to market. But then it's on us to ensure that the way in which it's delivered is consumer friendly, it's easy to use, and it's understandable, and it solves real world problems.
And I think that there is a lot of work about that for regulators, for overseers, and obviously for the challenger FMIs or the legacy FMIs, in the sense that to try to understand what are the risks that are being created. Obviously, you have means to do that. And some of those means are, for instance, simulating those systems, stress testing those systems, which is something that FNA works on actively with FMIs. And obviously that overseers, as we already mentioned, should enforce those PFMI principles that are, have a long history of being or taking care of the risks that we know that affect this type of ecosystem. Obviously, from my risk management perspective, we have several types of risk, and perhaps the most difficult to deal with is those risks that we don't know that we don't know. But obviously, that's something that happens in all industries, and that's something that the industry has to come up with some solutions to it.
But it's a great point that you're making, Carlos, that it echoes a little bit of what was discussed earlier in the chat. But if the new solution meets the same bar in terms of regulatory adherence and having the correct processes, incident management procedures, governance in place, then it should be on par in terms of its ability to mitigate risk.
I have one very interesting question that it tries like to make a follow-up to the question that of the 5 years time. If in 5 years time we're going to see some great advancement in the what challenger FMIs do for the cross-border wholesale payments. It goes like this: if challenger FMIs have a strong technological position and are well connected with central banks and commercial banks around the world and are solving a rather topical problem that we all know about, why is the scaling of the solutions not as quick as one would expect? Is there like a reason for this?
I mean, it's a really good question, and I think any new product rollout has a gradual rollout curve. So adoption will take time to roll out. And if you are taking the regulatory first approach like Fnality has, it means setting up regulated payment systems in multiple jurisdictions and working with the relevant local central banks and regulators to establish the financial market infrastructures in those jurisdictions, and then connecting that. So that regulatory path has a time frame attached to it to make sure that all the boxes are ticked and all the I's are dotted and T's are crossed. However, I think what I can also say is one should look at when assessing the ability to scale, one should look at who stands behind the startup players or the new technologies. So if you have a payment system or a startup business like Fnality backed by globally systemic important banks that we also see as our anchor clients and actively engage with as shareholders, but also as future participants, gaining their trust in the venture through backing it financially, but also backing it from a use case adoption and participation point of view is critical and instrumental to the success of the venture, and something we invest a lot of time in, and we believe provides us with a way to scale faster because we have our shareholder community as our anchor clients.
Thank you, Jan. Perhaps the last one, or perhaps we can have two of them. In your opinion, what are the latest developments or evolutions in cross-border payments, and what this means for payments providers and their corporate customers?
For me, I mean, I think you can guess how I will answer. But for me, DLT technology is the most exciting development in this space, especially for corporate clients, because if I think back to my time as a corporate banker, I think the way in which letters of credit are done, that way hasn't changed in more than a century. So it's still very paper heavy. It's still there's still a lot of cost and uncertainty in that process. So that's one example where it's completely programmable. It's from an import-exporter point of view, there's certain conditions attached, and if those conditions are met, do you have a bill of lading? Can you release the funds, depending on what the different agreements are? There's a possibility to provide much greater certainty to both importers and exporters, and create a much better cost point for corporates and much better transparency, which again has a broader impact by enabling trade and the flow of money. So that's one example. So I think this idea that money can be smart and money can be programmable, and that you can add your conditions to a bit like you would do with escrow and a couple of law firms. You can do that with technology, real time and really fast and really resilient. That will enable many use cases such as trade finance, and also a margin and lots beyond that.
Thank you, Jan. And I'm going to add a little spice here. Do you think really that DLT or distributed or blockchain or something like that is required to have programmable money?
Probably not. The advantage that it gives you is resilience by having it distributed and not centralized in one place. So you could put code on a central server or central hosted solution that enables that as well. It's a great point of discussion. I think the choice of your tech solution has to mirror what you want to achieve from a strategy and business point of view. DLT enables programmability on a decentralized way, where the participants can have a hand in how that works, but it also ensures that resilience through no single attack vector, etc., is much greater. So there's other benefits that it brings to the table as well.
Thank you, Jan. I think we run out of time, but it was perfect timing. So thank you very much, Jan, for being here with us. It has been a very interesting, very comprehensive explanation of what Fnality does and how Fnality is trying to solve these problems for the cross-border wholesale payments ecosystem. It's been very interesting. We've had a lot of questions that unfortunately couldn't make to the Q&A at the end. So once again, thank you. Let me tell you that in September 2022, we still have on September 28th, the Subtech broadcast #1 with Regnology. On September 29, we'll have CBDC broadcast, once again with me, with John Valisaris and Raul Thomas Herborg from Accenture and G+D. If you want to get in touch with us, you'll have in the slides the links to contact us. If you want to have schedule a demo to explore how FMI's life cycle, all the CBDC simulation solution works, that's something that you will find a link to interact with when we send the presentation, the slides to you. So once again, this is the end of the fifth episode of the FMI broadcast. Thank you all and have a very nice day. Thank you, Jan, once again.
Thank you very much, and thanks for all the questions. Thank you.
Thank you.